Hi guys, Fred Kitchen with Henson & Kitchen Mortuary and the 411, and this is episode number 6. I want to begin and talk a little bit today about life insurance and understanding what you have, okay? We're going to be talking about life insurance and trying to understand what we have and maybe even what we need. So we're going to go through the 5 common types of life insurance. We'll begin with whole life insurance. Whole life insurance, the premiums will stay the same over the life of the policy. The death benefit also stays the same. So your premium amount, the amount that you pay every month, is going to stay the same over the entire life of that policy. And then also the death benefit in which you purchased will stay the same over the life of that whole life policy. This is a pretty common policy that we see on a regular basis, a whole life insurance policy. There is a universal life policy. The universal life policy, you can vary the amount of your premium with a universal life policy by using part of the accumulated earnings to cover part of the premium cost. So you would need to really talk to your insurance agent about that, whether you go with a universal life policy or not. Typically on a universal life policy, there is some flexibility there to do what we was talking about, but you will pay higher administrative fees within the insurance, and all insurances usually have administrative fees built into those that oftentimes you don't even see. Okay, so we talked about whole life and universal life. Now we're going to talk about variable life insurance. Variable life policies build up a cash reserve that you can invest. You can invest that into other choices offered by that insurance company, and that is a variable life. The value of the cash reserve depends on how well those investments are doing that you invested in. So that's kind of getting a little bit more risky type insurance, whether you'd want to get there or not. Another is term life insurance, okay? There are 2 types of term life insurance we're going to talk about. We're going to talk about level term and decreasing term, okay? Both of these policies, anytime you buy term insurance, there is no cash value, all right? So we're talking about the 2 policies. Let's talk about the level term. The level term means that the death benefit in which you purchase will stay the same. It'll also mean that the premium will stay the same also on that. That's the level term life insurance policy. So, and usually those are for a shorter period of time. Let's say they might be 10 years, 20 years, 15 years, something like that. And that's a level term. And then at the end of that, should that insurance expire, there is no benefits, no refunds of dividends or anything like that with the level term. There is a decreasing term life insurance policy also. And it does exactly what it says. It decreases in value each year, usually on a yearly basis. So if you bought a $20,000 life insurance and had that for 20 years, we'll say, then probably at year 19, you would probably have maybe $1,000 left in that policy for a death benefit should you pass away. A lot of times these type of policies are used to cover debts for businesses and business owners and things like that, or anyone that has a high debt ratio. Okay, so we've talked about the term life insurance, the 2 type of term life insurance policies. So let's talk about one other, which is an employer's group life insurance plan. Typically, these insurance plans are going to be the least expensive of all the insurances because it's a group policy through your employer where you work. Now, the only thing is a lot of times these policies are not transferable. So you retire or you would leave that place of employment. Sometimes you have no insurance at that point. There are instances where those can be carried on. You can go ahead and carry on the premium, and usually your premium will increase a little bit there, okay? Let's go ahead and talk a little bit about, should you review your insurance yearly, or how often should we do that? Okay, so one of the things that you should do, you should look at your insurance policies that you have, or your policy, at least on a 5-year basis, maybe every 5 years, but yearly is best, that's optimal. And what you want to be looking for are, especially if there's life changes. You want to make sure that your beneficiaries are up to date. You want to make sure that there's no other life changes. Maybe you've bought another home and you need more coverage to cover your debts and things like that. So those are things you may want to be looking at, and an insurance agent would help you do that. But here are some things that's going to trigger when you should update. Anytime any of these things happen, you should probably look at your policies and look at maybe doing some updates. So here we go. The marriage or a divorce, those are 2 things that you would want to look at. to see if you need to make changes in the policies, especially if you've divorced someone. You probably don't want to leave them as your beneficiary to receive your funds. I don't know, maybe you do, but anyway, that's something that you got to look at there. A child or grandchild who has been born or adopted, significant changes in your health, significant changes in the health of your spouse, taking on the financial responsibility of an aging parent, something else that would trigger a time when you should look at your insurance and kind of review those things. A loved one who requires long-term care, refinancing your home or purchasing a home, an additional home, or even coming into some type of inheritance. These are all things that you want to do to kind of start a review policy, a review procedure of your policies to kind of make sure that everything is in order and up to date. Now, one thing I will mention that we see on a regular basis in the funeral home setting is beneficiary information not being accurate. And what that ends up doing is slowing down the entire insurance process for you. Still something that can be worked through, but it slows it down a little bit. So, you know, maybe your parents made each other their beneficiary, and then one of them passes away. So when the second one passed away, they made no changes. You just didn't think about it to make any changes to the beneficiary. So now you're going to need not only the first parent that passed away, their death certificate, you're going to need this parent's death certificate along with some additional paperwork that you're going to have to do. So those are things you have to look at there. And then in some cases, when there's not an updated beneficiary, the insurance companies will only pay the benefits to the estate of the deceased. So then the administrator of the estate would have to administer that estate. That's how that would kind of work. So definitely something you want to do. Something I want to mention is that if you ever want us to help you kind of look at these policies, we are a life insurance agent in the state of West Virginia. We would be happy to kind of look through them and just kind of give you some advice or some information as to what you have regarding insurance. Hope this video has been helpful, and continue to please share the videos. Want to thank you for doing that, and continue to look at our Facebook page on Facebook and like us. Really want to say thank you for all the outpouring of support for these videos and for sharing them with your friends. That's how we get the word out. Thanks again. Until next time, take care. Bye-bye.